Hello, I'm Catrina M. Craft, and you've just tuned into the Craft More Cash podcast, where finance meets innovation and strategy becomes reality. With over 2 decades navigating the twists and turns of accounting, tax, and business strategy, I've had the incredible opportunity to work with startups and Fortune 500 companies alike, crafting pathways for businesses to grow and thrive. I've tailored my expertise to serve the unique needs of industries ranging from real estate to creators to marketing and beyond. I'm on a mission to equip individuals with the financial savvy they need to succeed. Through my Wealth Intelligence course, I'm all about breaking down complex concepts into actionable strategies for business owners. So buckle up and let's dive into the world of financial success, innovative strategies, and the stories that make us all want to keep pushing forward.
We talked about certain employee meals, like if they're furnished on business premises. So we want to talk about that. We're going to go into more detail, and that's the little trick I want to help you with as far as retaining your employees, what we can do for our employees with meals. Also, office parties remain 100% deductible. Well, we know that right now, employers are struggling to hire and retain employees. If you are one of those employers, you may want to offer more tax-free fringe benefits. Those are benefits that are not taxable to your employees, but can be a deduction for you. So that's a way to incentivize employees when you are interviewing, or to incentivize employees to stay. It's really one of the proven ways to really help your employees. Common examples of tax-free benefits are health insurance and paid vacation. So we're aware of those. Also, retirement planning and retirement options that you're providing additional funds for your employees during retirement. Those are all common benefits. But let's look at, there's another potential employee fringe benefit: free meals, usually lunch. Free meals not only make your employees happy, but they keep them on premises and generally make them more productive. The deduction is scheduled to end in 2026. So we really have a lot of time. We have this year through 2026. So if this is a perk you want to give your employees, then the time is now. But not all meals are tax-free benefits. So you need to know how to make this a tax-free benefit. It has to be in kind. So no cash alternative for not taking the meal. So you have to give them a meal. You can't say, well, if you don't take the meal, I give you money. That will not work. It has to be the employer's business premises. So it has to be your premises and where your location is, and it has to be for your convenience. So that means if you are working on trying to get a product out and you're under tight deadlines, then it's your convenience for your employees to actually stay and have the meals on premises. Also, the most common way to pass the convenience test is to establish that employees can't get their own meals within a reasonable time. So that means if you give them 15-minute breaks, you may be in a location where it's no way they can go get their meal within that time period. That's important to establish. Also, we know that now meal delivery services such as Grubhub, DoorDash, and Uber Eats makes it harder for you as the employer to pass the convenience test. But if you still want to do the tax-free meals, what you need to do is not enough time test should prohibit use of meal delivery services. And you have to document why such services are not viable for them. For example, due to disruption or security concerns. So knowing the tips and how to maximize is very important. I'm always looking for, if they say you can't do it, well, how can we put these rules in place so that it's still a deduction for you? And this is one way. You have to document. It is so important to document rules, reasons, document, it's not reasonable time and why. All of those are important when we want to talk about offering meals. Entertainment used to be a big part of businesses, and they were able to deduct entertainment expenses if they were doing business building, working with current clients or looking for prospects, but that has gone away. In the 2018 bill, all of the, was passed in 2017, but 2018 through 2026, entertainment is zero. There is not a deduction for things like event tickets. If you're going somewhere, event tickets, plays, deep fishing, concerts, and such. But there may be a way where if you want to give a gift to a customer, as long as it's $25 or under, you can give that one time each year. So that could be a way that you can do a little bit of entertainment without jeopardizing trying to deduct it on your tax, because it's not allowed. Now let's talk about retirement options for your business. I love talking to business owners about retirement, because where else can you have retirement? Pay yourself for money that you're going to have in retirement, put it in your retirement account, and you get a deduction for it. That could be 3xing your money, depending on your tax rate. That's really a win-win. So I encourage business owners to have some type of retirement plan in place. Also, I want to just talk about the retirement options for you. After you reach age 50, you can make additional catch-up contributions to certain types of tax advantage retirement accounts. So I know a lot of times people, as a business owner, they may know about the retirement plans, but they're missing out that when they reach 50, and you just have to be 50 or older on the last day of the year, you can start doing a catch-up contribution. That means you can contribute extra money above what everyone else can that is younger than 50. Specifically, so you are your own employer, you are an employee of the company, and you have an employer sponsor 401k, 403b, 457, or simple plan or SEP plan. You can make salary reduction catch-up contributions to your account, but you need to make sure that your contribution in your account and your plan allows that catch-up. You need to make sure the documents indicate that you can allow catch-up. That's why it's important to work with financial advisors to make sure your plans are set up properly. If you're self-employed and have set up a 401k plan or simple IRA for yourself, you can make extra catch-up contributions to your account as well. Finally, you can make extra catch-up contributions to a traditional or Roth IRA too. I like to talk about the SEP plan, because that's a plan that if you did not know as an employer that you can have some type of retirement plan, a SEP plan allows you as a business owner, you can still contribute by the end of your tax return due date. So it's one that if you haven't set up a 401k plan or some of these other plans, you can still do a SEP contribution. So make sure you talk to your financial advisor about that, but it needs to be done before you file your tax return. The retirement options for your business owner. How much are catch-up contributions worth? Some people are really eagerly, they embrace the chance to contribute more money, but I know as business owners, we're really trying to invest more money into our business. And a lot of times we don't think about really our own retirement and what we want to do once we retire and how much money we will have. That's why I really want to focus on looking at what does it mean to catch up? How much money is that worth? Let's look at the IRA catch-up contributions. Let's say you turn 50 during 2021 and you contribute an extra $1,000 for this year. You do the same for the next 15 years. So overall, you've contributed $16,000. And I'm just assuming 1,000. This number may go up, but I'm just going to assume until you're 65, you're going to contribute $1,000. That's $16,000 you've contributed. With the rate of return, 4% return, you would have had $22,000 by 65. If we have a return of 6% in the market or whatever you invest in, 26,000, and 8% return, you'd have $30,000. That's almost double. That's why I really encourage you to do retirement as a business owner. Now let's look at the 401k. I like the 401k because you really can maximize, and it's a deduction on your business tax return. So where can you do a profit sharing? That's what I would recommend. If you have some type of profit sharing, that's a deduction on your business return. Why wouldn't you do that? Let the IRS pay for some of your retirement. So on this example, let's assume you're 50 during 2021. And for, again, 15 years until you're 65, you're contributing this extra $6,500. You've contributed $104,000 over 16 years, but look at the value. 4%, you would have had $142,000, 6%, $167,000, and 8% return, $197,000. Again, almost doubling your money that you initially put in. And I'm not even factoring in that a piece of this, if you're doing some profit sharing, it would even increase. You would have more of a return because you would have done a profit sharing and put more money into the account by the business. Let's talk about another option for business owners. It's called self-directed IRAs. The advantage of this is it's similar to an IRA. It's a great way to save, but what happens is it's self-directed. That means you can decide what you want to invest in. You walk, if say for instance, you're a little bit more risky and you don't want just standard investments, you want to walk on the wild side, you can invest in things such as real estate or even cryptocurrency when you have this self-directed. Here are some of the things you can invest in: real estate, private businesses, trust, tax liens, metals, again, hedge funds, and cryptocurrency. But there's a way that you need to make sure that you're understanding self-directed, because you cannot self-deal. Make sure that you talk to a financial planner that understands self-directed, because if you self-deal and do prohibited transactions, you could lose all of your tax advantage status. But I have had several clients to do self-directed with real estate, and they just do not self-deal. And when they sell the property, it's not taxed because it stays within inside of this self-directed, and it's a way to really maximize savings in your business. If you want to do a business ownership, you can, but again, you can't self-direct, can't be self-dealing. So that's very important. But let's watch out for 2026. We really don't know what's going to happen, because from 2018 to 2026, a lot of these tax codes and deductions were reversed from what was previously happening, or things were added. So like the tax rates changed. So we may go back to the past prior to 2018. We don't know what's going to happen. His policy is still being discussed. There are some things that would change tax rates, increase tax rates for certain individuals, increase tax rates for certain business C Corps, and also eliminate some different QBI tax that we've had. And those have been credits that have helped S Corps, partnerships, and sole proprietors. So if those are reversed, it can impact a lot of business owners. So we were talking about deductions and just how we can help with deductions, how the tax code really incentivizes business owners, and looking at some advanced strategies that you may not have been aware of that we can actually implement in your business, and look at retirement. We want to make sure that you've worked hard in your business, and we want to make sure that you have some type of retirement to retire on, and that's something that you've planned. Don't leave it to chance. Start planning now for your retirement. And remember that some of those different retirement options can be a tax deduction in your business. So it's really a win-win situation. Where do I go from here? You can learn to grow your wealth and develop financial intelligence by joining. It's a 6-week wealth intelligence program. So it's 6 modules, and every week you have homework, you have things that you need to go over, and you have a Q&A with me every week. And you're going to develop your net worth. You're going to have budgeting. You're going to look at QuickBooks. We're going to look at your KPIs, like what do you need to track? We're going to make sure that we have a plan that you wanted, and then by the end of that 6 weeks, you're probably going to adjust that plan because you're going to feel so strong and feel like now you have the wealth intelligence to make different choices.